Welcome to this Future of Finance Fire Chat with Benedikt Schuppli from Obligate and Andreas Ruflin from BX Digital. Lack of scale and speed are still cited as obstacles to the replacement of the status quo by blockchain technology. What is the solution?
Blockchains today and for the foreseeable future will not be able to compete with the scale and speed of highly centralized asset registers and systems of asset transfer, like central securities depositories and stock exchanges. A CSD like DTCC in the US has a volume of several quadrillions of securities transactions in US dollars processed annually. This is why I'm convinced that the higher the need for a decentralized system of asset transfer, the better suited blockchain is. And this is why private markets will rather be revolutionized by blockchain technology than, for example, FX or the public stock market.
How to solve speed and scalability? It is about how we design the architecture of the infrastructure. It's about an intelligent combination of off-chain and on-chain components. In our example, we have built the matching engine off-chain, whereas the whole settlement mechanism is running on an on-chain infrastructure. So now the next question is going to be, which is going to be the right on-chain solution? And I think for that purpose, you need to think about, what is the requirement the blockchain needs to fulfill. And I believe in a coexistence of various blockchains, because each of the blockchain protocols is meeting different purposes, and we're going to create interoperability to link these infrastructures together.
Interoperability between networks is essential to attract issuers and investors. Are we getting closer to the interoperability tools, e.g., Bridges APIs standards, we need?
Great advancements have been made in terms of technological standardization. We see the widespread use of certain security token standards, and we see the emergence of widely adopted regulated stablecoins. But what's, in our opinion, still missing is a higher standardization on the level of other elements which are really crucial, such as the standardized and reliable rating for assets. This is why it's crucial that also, the big rating agencies are providing more and more ratings for on-chain assets, and do so also in a more accessible, lower cost way. And also when it comes to legal documentation, legal standards, something that Obligate is working on is, creating a similar standard for the blockchain space and for digital securities, like the ISDA agreement has become for the derivative space. And as soon as we have more standardization there, we will have more adoption and global acceptance for these new financial instruments being issued and transferred.
Interoperability is very important, and we have to solve it. Technically, there are solutions how we create interoperability. There are various initiatives and protocols which are linking these different protocols. What we are seeing currently that they are not sufficient mature to meet the regulatory standards and requirements with respect to integrity. That means that currently we are not using interoperability layers, but in the future we are very much looking forward to use them as soon as they are sufficiently mature.
Nobody disagrees that interoperability between the various networks on which financial assets, money as well as securities, are issued, traded, settled, and custodied is essential to success. Do you think that is best achieved by a centralized, standardized single model or by a decentralized virtual network of networks?
I think it is not going to be the central authority defining standards, as it used to be in the traditional work, such as SWIFT, which is creating the messaging standards. The new world is going to be a coexistence of various standards with interoperability between the standards. Nevertheless, obviously, we see some alignment initiatives. Let's take an example on the tokenization standards, where we have our Swiss standards, the MTA, which we very much rely on, but which is collaborating nowadays with the European initiatives of standardization and of the tokenization.
There is a consensus that the availability of fiat currency on-chain would be positive for token markets in eliminating the costs and inconvenience of making payment for tokenized assets through traditional banking channels only, and providing a stable, trustworthy, and low-cost alternative to current on-chain forms of money such as cryptocurrencies, stablecoins, and e-money. How constraining has the lack of truly digital fiat currency been for your own business?
We've been able to cater to customer demands so far very well with the existing stablecoins, particularly focusing on regulated ones such as Circle USDC or EUROE, which is regulated as electronic money in the European Union. And this has been accepted by both the issuers and investors. However, we also see that some institutional players, particularly on the investor side, larger asset managers and obviously also banks, they will require a different set of stablecoins, actual commercial bank digital money, or then full-fledged CBDC issued by a central bank. And I think once we have that really full-fledged and interoperable commercial bank digital money, not just one that is issued by one bank like the JP Morgan coin, then I think this will open the floodgates for another, just mass wave of institutional blockchain.
Do the benefits of atomic settlement, elimination of counterparty risk, outweigh the costs pre-funding loss of netting?
I do believe that the benefits of atomic settlement outweigh the cost and the risk associated with it. If we are looking at real-world assets, the risk of, for example, just completely, sending some type of instrument into the nirvana is less of a risk than we have with, cryptocurrencies, because they do have a representation in the legal world. We can nullify or avoid digital securities that are being issued and can issue new ones, for example. So there's legal behalves that we can rely on to actually, address the risks associated with these. And then obviously the benefits, I think, are incredible, right? Rather than just relying on another intermediary doing delivery versus payment, we can use technology to really fully replace the role of a financial intermediary. And one of the starkest examples of this, I think, is, for example, delivery of coupon payments, which to this day, in traditional bond issuances, is still done manually in some cases, where a coupon is ripped off, put into a box, sent physically to the central securities depository, where then the paying agent will do manual transactions, manual transfers of coupon, and this is just something which is so far outdated, where with atomic settlement using delivery versus payment smart contracts, we can and we can distribute coupons with one click to all the addresses that are registered.
The advantages are definitely outweighing the disadvantages. In principle, the faster the better. And the nice thing at the atomic settlement is that we really settle the asset leg with the cash leg in an atomic manner, which eliminates a lot of problems, such as the counterparty risk, if there's someone in between. Obviously, it has some challenges. It is a completely new aspect or way how to settle, and the community needs to adapt to support this kind of atomic settlement processing.
6. The benefits of tokenization ultimately hinge on achieving high levels of reliable automation. Has smart contract technology achieved the necessary degree of reliability and security?
I think it did. It's a matter of auditing. I think the attack vectors are clear, and therefore again, if we talk about institutional grade assets, where we do have a representation promise in the legal world that exists also to an extent if the blockchain, for example, has uptime issues. I think we can, today deal very well with the risks associated with smart contracts. I do think what's important is, however, to have, a more reliable framework to assess these risks, so that can also be reflected in pricing, which then again will, I think, really be a game changer when it comes to bringing more institutional liquidity on chain. Because for many institutional investors right now, they have a difficult time pricing the perceived technology risk using blockchain technology such as smart contracts. The more reliable framework we have there, the easier it will be for them to accept it and to price it, and then accordingly, move more liquidity on chain.
The very good news is that from a security aspect, smart contracts have a huge advantage. There's no single point of attack, so we get rid of the cybersecurity challenges we're currently facing. That's the good news. The challenges or the bad news is that there are two aspects of security. First of all, the smart contract is as good as it is programmed from a security point of view. For that purpose, you need to do the technical audits, which we do for our smart contracts. And the second aspect, which is a little bit the challenge, is that the integrity of the blockchain need to be guaranteed. And not every blockchain is meeting the high requirements of integrity that we impose on the infrastructure.
Does rapid progress depend on working within existing securities laws and regulations, or on rewriting existing securities laws and regulations?
I think it depends on the type of asset that is being tokenized, and also what we mean by tokenization. If we look at traditional financial instruments and we look, for example, at the European Union, there's a reason financial instruments are being carved out of MiCA, because we already have the rules that apply to them. Just the basic fact that we use a different vehicle of issuance and transportation for these assets does not actually, mean or require a new form of legislation. So I do think in the end, we have the tools to regulate and deal with most applications of blockchain technology as they relate to traditional financial instruments. If we tokenize different types of assets, maybe new legislation is needed. And I think what's also important is if we then really make clear that these assets are financial instruments, then also all the other regulation that is associated or touches on this term will also come into force, such as market manipulation, insider trading regulation, etc., which I think is very valuable for the protection of the system and the market.
If your ambition is to really do native tokenization, then you need obviously to amend your current laws in a way that is supporting this kind of new tokenization. We did that in Switzerland about 2-3 years ago, and we are currently using this kind of new aspects of the law to support native tokenization and to combine it with the infrastructure required to support the tokenization market.
Legacy service providers are fearful or investment costs, the novelty of the risks and disintermediation. How can we best ensure greed conquers fear?
I absolutely agree that the legacy provider are fearing the change, as every human is afraid of the significant changes going on. What we see in the market, that there are a significant amount of players who really embrace these futures and that take this as an opportunity and make the investment and really go step by step towards this future and are trying to really figure out where they can play in the future a crucial role in this new ecosystem.
The buy side, asset and wealth managers, seems readier for radical change than the sell side, banks, brokers, financial market infrastructures. Do you agree?
I disagree. I think both sides are ready. It's not the buy side who is readier. And at the end, it requires both. The buy side is very keen on getting access to these new tokenized products, and the sell side, they are really looking forward to the new investor community getting access to their products. So I think, and that's how we really observe our community, we have nice issuers which we have onboarded, and we are as well onboarding very nice buy-side participants.